Hello, welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here at AusBiz as we get off on a new week, of course, recovering from the drama of last week. Well, let's in fact take a look at where we finished up. On Wall Street, stocks there continuing their ascent in the wake of Donald Trump winning the presidential election, whereas in Europe, shares finished weaker. So the S&P 500 and Dow registering their biggest weekly gain in a year, while expectations for lower corporate taxes and deregulation lifted the Nasdaq to record closing highs for 3 straight sessions. And the small cap Russell 2000 up around 8.5% for the week. That's its best in 4.5 years. Now, investors are considering a clean sweep for the Republican Party, having won the White House, Senate, and possibly the lower house as well. Airbnb shares fell heavily after the homestay company missed third quarter profit estimates, while shares in social media company Pinterest tumbled after a disappointing revenue forecast. Online travel platform Expedia shares rose after it beat quarterly profit estimates, helped by strong international travel demand. And Tesla's shares continued to rally on Friday, taking the company's valuation above $1 trillion on expectations that Chief Executive Elon Musk's companies will get favourable treatment under a Trump administration. And US-listed shares of Chinese companies fell as the government's latest fiscal support measures failed to impress investors. Well, expectations that President-elect Trump's economic platforms, such as tax cuts and tariffs, will lead to faster growth and higher consumer prices has again lifted Treasury yields. They've surged by more than 70 basis points since mid-September and recently notched their biggest one-month gain since the 2008 global financial crisis. Fed funds futures now showing investors are expecting rates to decline to about 3.7% by the end of next year from the current 4.5%. And that's about 100 basis points higher than what was priced in September. Traders pricing in 65% odds that the Fed will cut again by 25 basis points next month. Well, the 10-year Treasury yield eased on Friday to 4.31%, this after the University of Michigan's Consumer Sentiment Report showed one-year inflation expectations fell to 2.6% in November, and the 2-year Treasury yield rose to 4.25%. And the US dollar rose on Friday, with the dollar index up to a 4-month high immediately after that election result. The Aussie dollar, often used as a liquid proxy for its Chinese counterpart, tumbled 1.5% over the week and is currently at 65.8 US cents. Meanwhile, China's National People's Congress delivered a little more than what had been previously expected on Friday, pledging 6 trillion yuan, that's around $2 trillion, to ease debt repayments for local governments. Well, that underwhelmed markets and did put some pressure on commodity prices. Oil fell at the end of last week as prolonged supply disruptions caused by a hurricane in the Gulf failed to eventuate, while that latest economic stimulus package out of China also disappointed the market. Brent crude futures down 2.3% to $73 a barrel. Metals prices fell, with copper losing almost 3%. Iron ore down a similar amount to $103 a tonne. And the gold price saw its steepest weekly decline in more than 5 months, down 1.8%, pressured by a stronger US dollar. Spot gold at $2,683 an ounce. And Bitcoin rallied further over the weekend, touching 80,000. In fact, that's where it's back up above 80,000 as we speak. So let's get across what we've seen, particularly on Wall Street, in the wake of Donald Trump's victory in the presidential election and what it means for equities. Lachlan Hughes joining us from Swell Asset Management. Lachlan, great to catch up with you again as we look back at that really eventful week and the Trump trade very much in play.
Absolutely, Andrew. Look, it was an interesting week on Wall Street, but what I would say about that is the economy has been a good predictor of the future from time to time, but it's also been a very poor predictor of the future from time to time. So we're not reading too much into the movement we saw. And I guess, as you mentioned in your introduction, that the two big issues that Trump campaigned on, one was tax cuts and the other were tariffs. But look, we know politicians tend to overpromise and underdeliver. But if we unpack the taxes and the tariffs, well, firstly on the tariffs, obviously they're inflationary. And these tariffs are going to be a lot broader than the tariffs that were proposed back in Trump's first term. So look, that's going to be inflationary, and that's a worry for consumers. Part of that is the tax cuts, which are going to come to offset some of those. But the big problem for the US is they already run a current account deficit, and tax cuts will obviously increase the deficit, and this has to be funded by government. So we'll see an increase in government debt. And we know in the US already at the moment, government debt is at record levels, and it's not a problem with markets until it's a problem. So I think investors have to be cautious about the backdrop there. And I think that all sort of tends to go towards a slow, like a lower growth economy. And if inflation comes through, I think that's very bad news for President-elect Trump. And I think that's part of the reason why he is trying to control the Federal Reserve and interest rates, because if we do get inflation in the US, we'll see interest rates rising. So look, I would say that the Fed's on autopilot at the moment, expecting another cut at the next meeting, but I think they'll take a wait and hold approach at that point. But obviously, President-elect Trump would like to see interest rates lower to help with his economic agenda. But really for us at Swell, we just tend to come back to the valuations. And if we look at a company like GE Healthcare, they won't sell any more MRIs, whether it's a Harris presidency or a Trump presidency. So nothing changes there. And to the extent that the market has rallied and these valuation gaps have closed, all that means is the future returns are lower. And we're sort of assessing that on a daily basis. So look, we're taking it, we'll take the result, we'll watch what happens, and we'll see if those broad-based tariffs are implemented. But look, it's anyone's guess at this stage, Andrew.
So, Lachlan, any parts of the market that you're thinking are likely to outperform? Just take a look at small caps, for instance. As I mentioned there, the Russell 2000 up 8.5%. Where are you seeing that growth at the moment?
Well, I think we've looked at across the market. I think oil and gas is obviously going to be a favourable sector. We know government's going to support that part of the market, so I think that's going to be a positive. There's certain areas obviously want to avoid. Healthcare, there's pockets of healthcare we like, but parts of healthcare we don't like. So we're going to be quite selective there. And I think broadly, when we came out of the most recent reporting season, the one part of the market we still feel really optimistic about is the cloud sector. And if you look across Amazon and Alphabet and Microsoft, each of those companies delivered very strong growth in the cloud. And I mean, despite the fact the cloud has been here for nearly 20 years, only 10 to 20% of workloads have transitioned to the cloud. And the backdrop with generative AI, it's going to be a very good period because we're going to see more workloads move to the cloud, and we're going to see an acceleration of the spend with generative AI. So look, we feel really good there. And the biggest cloud companies are the ones we've invested in, the hyperscalers. And they're so large that they're actually producing their own AI accelerators. So they're in a very good position. They're obviously still buying NVIDIA chips, and that's helping them with their current business. But they're going to keep on vertically integrating, spending money on their own accelerators, and this is going to produce a lower cost to serve over time for these companies. So we really feel that very strong economic moats around these businesses. And that's one area that we're very excited. And look, we've owned Microsoft for nearly a decade. And there's been times not to own it. The market will tell you from time to time they don't like, the transition from the license model to subscription. And at the moment, the market's a little bit concerned about the amount of money these companies are spending. The CapEx is huge by any standard, but they see a real opportunity. And this is the mode of the future, and they're going to continue to invest. And yeah, we feel very good about those companies.
But what more broadly with the tech sector there, anticipation of the Trump administration will see fewer regulations. And I guess you look at a particular company in Tesla has done very well since that election, no doubt because Elon Musk has the ear of the president-elect.
That's right, Andrew. That one's a little bit of a head scratcher for me. I did watch the most recent robotaxi. I still believe the robotaxi is a ways off yet. Their competitors, whether it's Waymo, they're rolled out in 2 to 3 cities in the US. They're taking people on rides every single day and have been doing so for some time. And whether Elon Musk's able to take advantage of the position he has in the Trump government, I think we'll wait and see. I guess the big part is maybe they get their regulatory approval to roll out their self-driving a little bit quicker. Perhaps their robo-taxis may be approved sooner than they otherwise would be. But yeah, look, that's one we'll keep watching. I think a large part of the valuation for a business like Tesla is long-term opportunities like their robot, like the solar business, like the robotaxi. So when people get excited about the future, as they seem to do a lot with Tesla, that's when we see big rallies in the share price. And obviously,
Yep.
crypto is a little bit part of that too.
Absolutely. Now, Lachlan, another company that you've been focused on is Zillow. That's that tech real estate marketplace. What are you seeing there at the moment?
Well, Andrew, they reported really well, and it's one we've talked about previously, and it's up sort of 30% post the result. The US housing market is under a lot of pressure right now. Mortgage rates are very high, so high that people have stopped taking out mortgages, and the number of transactions per year have dropped from nearly 6 million to 4 million. But despite this backdrop, Zillow's managed to grow their residential business, which has been a big positive, but they've also expanded into new areas. So we saw mortgage growth, which was very fast, and also their rentals business. But it's really a very favourable setup as the market begins to thaw. And look, we may see if interest rates keep falling, we may see the mortgage market pick up faster than expected. But we really like the long-term setup for this business. It's well managed. They have a very strong business model, very good brand awareness, and yeah, look, they're the leader in the space. So that's one business that we have owned for some time, and we still feel very optimistic about the future.
Lachlan, great to get your take, particularly in way to the election and how it is moving the market there on Wall Street. Thanks for joining us from Swell Asset Management.
Thanks for your time, Andrew.
All right, so let's return home then, take a look as we just get underway in a couple of minutes' time. Looking for a negative start, as you can see, SPI futures off more than 0.4%. Certainly the focus will be on what we saw out of China on Friday, which once again largely disappointing markets. We saw that in particular with the focus on those metals prices. So stay with us, we'll get you right across the open when we get underway in a couple of minutes.